Am I the only one who do not understand why pension fund like Singapore CPF strictly limit the amount of money that can go inside your CPF? That's like 37,000 Sing dollar a year. Even if you earn high salary like 8,000 Sing dollar a month or above. Even if your total salary deduction is below 37,000 a year and you want to self-top up your CPF, Singapore government also does not allow you to exceed this $37,740 a year limit. Then there's even monthly limit one. Wow, so complicated. I have a wild theory on this. See if you agree or disagree after you listen to my explanation. As a Malaysian licensed financial advisor, I have never worked in Singapore, but this piques my curiosity because in 2023, I have an influx of clients who are Malaysian working in Singapore as a Singaporean permanent resident, earning like yearly 6 figures in Sing dollar, engage me for advice to plan for their retirement back in Malaysia. Now first, this is what I understand. Your CPF money is invested into Singapore government securities, also known as SGS, which is actually Singapore government bonds lah, but not the plain vanilla version. It's a special version of Singapore government bonds, just like your burger ayam, but burger ayam special lah. In other words, every CPF contributor had no choice but to buy Singapore government bonds, whether you like it or not. Singapore government literally takes, or should I say, you are obligated to lend your money to Singapore government and do what leh? If this is US government will use the money raised from selling US treasury bills, notes or bonds to fund its war machine, like sending money to Israel and Ukraine. But no. Singapore government, after receiving your CPF money, will send it to GIC to invest, co-mingle with non-CPF monies that the GIC is managing. They are not even going to use a single cent of your CPF money to pay the public servant salary or the government expenses. Now, when Singapore government borrows your CPF money, they are using that entirely for investment purposes. In other words, Singapore government borrows your CPF money, which you are forced to contribute as a salaryman, not because it needs to, because it wants to. Cause why not? OPM concept lah. Whenever possible, you use other people's money to generate investment returns. Other people's money, leverage, right? But what does GIC invest in from its co-mingled pool of monies? The answer is 40-ish% in bonds and cash, and then 10-ish% in real estate, 30-ish% in global stocks, and around 15-ish% in private equities. Now, on average, CPF promises you a minimum 2.5% return on your ordinary account and a minimum 4% return on your special and MediSave account. But Singapore government also wants you, the CPF contributors, to know that there is no link between CPF interest rates and the returns earned by GIC on any given year. However, when you look at GIC yearly investment returns, there are years where the returns drop below 4%. Yet, CPF still deliver 4% or above to you in those below 4% return years. How so? Because Singapore government actually guarantees it with its own balance sheet. In other words, Singapore government liquid asset. In fact, Singapore government transparently acknowledged this, citing the 2008 global financial crisis as an example, where it says GIC suffered 5 years of low returns due to the loss incurred during global financial crisis. Now see this chart of GIC yearly returns again from 2009 to 2013. Bear with me on this because I have not digressed from this golden question. Why CPF strictly limit the amount of money that can go inside your CPF? Again, 37,000 Sing dollar. So Singapore government indirectly implies that it is very rich, although you may not be lah. Now, from this statement, the government has a significant buffer of net assets, which are more than its liabilities, CPF commitments included. And that Singapore government net assets can easily absorb the risk of GIC not making enough returns to pay the 4% minimum guarantee returns to CPF contributors. Why Singapore government so rich? Because Singapore government rajin menabung sejak 1965 after it bercerai lah dengan spouse dia yang terlalu toxic sekali. You tahu siapa? 50 plus years of savings being invested, earning compound returns. Don't tell me you are still poor, man. Plus, selling land banks to property developers lah. and also hiking COE prices 10 times from 10,000 a year to over 100,000 a year for the past 15 years. Alright, the bottom line is this. 4 scenarios when it comes to your 37,000 CPF annual limit. Now, let's go to scenario 1. Imagine the Singapore government borrows $100 from you as a CPF contributor, and it passes this $100 to GIC to invest. In a good year, that $100 return, say 5%. So that is $5. Nice. Everyone happy? No questions asked. Now, let's go to scenario 2. In a bad year, where both stock markets and bond markets crash, like in 2022, 2023, that $100 only returns, say 3%. And only $3. And it falls short of the 4% guarantee minimum return you as CPF contributor should receive. So Singapore government steps in and imagine it has $100 assets and $70 liabilities. In what it says as no net government debt or a net creditor nation, Singapore government just needs to cover the $1 shortfall to you as a CPF contributor. Now the government net assets reduce from $100 to $99. No issue. Imagine if the Singapore government does not restrict your CPF contribution. Now you can put how much money that you in without restriction. This is what I think it would happen in this scenario 3. It means that, okay, Singapore borrows 1,000. It means that the Singapore government borrows $1,000 from you instead of $100. So now it passes this $1,000 to GIC to invest, right? In a bad year where both bond and stock market crash, that $1,000 only returns, say, 1%. Only $10 out of the $1,000. And it falls short of the 4% guarantee minimum return that you as a CPF contributor should receive, right? So Singapore government again steps in and imagine it has $100 assets and $70 in liability. Singapore government in this case needs to cover the $30 shortfall to you as CPF contributor. Now that Singapore government net assets are reduced from $100 to $70. Remember, Singapore government still has $70 liability, but if its assets are now reduced from $100 to $70 to cover for its CPF obligations, mean its net worth now is basically zero. $70 asset minus $70 in liabilities. It is no longer can call itself a net creditor nation, right? Now, even worse in this scenario 4, imagine if droves of CPF contributions keep pouring in and it balloons up to $10,000. In other words, the Singapore government borrows $10,000 from you instead of $1,000 or even $100, and now it passes this same $10,000 to GIC to invest. And if that $10,000 only returns, say, 1%, which is only $100 out of $10,000 in a very bad year, and this falls short of the guarantee minimum return to you as a CPF contributor should receive, right? So Singapore government, as what they have committed, step in, but it only has, again, $100 in asset and $70 in liability. Singapore government in this case needs to cover the $300 shortfall to you as a CPF contributor. Now, Singapore government does not have enough assets because remember, they only have $100 in asset to cover CPF commitment, which is 4% per year. In this case, 4% out of 10,000 is 400. Guarantee, right? Obligated returns to CPF members. Yes? So, overnight, as you can see, Singapore can become a debtor country. So, what does the government do when it's running in deficit budget or desperate for money? It could be forced to borrow money externally to cover this debt hole or deficit, or they're going to tax you, the citizen, higher law. Make sense? And this also could be the reason CPF only can guarantee you 6% yearly return for your first 30,000 CPF balance and is capped at the first 20,000 for your ordinary account, and slightly lower 5% yearly return for the next $30,000. Tell me if I just cracked the code for all Singaporean residents or Singaporean permanent resident, or I'm just talking cock over here. I humbly want you to confirm or correct me. Picture a situation when a government runs out of money and is forced to dig into its tax money collected from its own tax-paying citizen just to pay out interest returns on its citizens' pension fund. Wouldn't it be like you pay tax to pay interest return on your own pension fund which you yourself contributed in the first place? A government in deficit can just reroute or churn this money one big round. At the end of the day, you are actually paying yourself with your own tax money.